The penalty for not reporting stocks on your taxes can be as high as 75% of what you owe, up to $275,000, and even jail time. But that does not mean you should be paying more than you owe. In this video, I'll show you a step-by-step to how stocks are taxed, give you 5 ways to beat the tax man, and legally pay less in taxes. We're talking how taxes on stocks work today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Ugh, taxes! Is this the last thing you ever want to talk about, right? I mean, I consider myself early if I get my taxes done on April 13th instead of the 15th every year. But you know we try to stay positive here in the nation, so I want you to think of this video, this topic of how stocks are taxed, as an opportunity. Nation, working in private wealth management, the first question our millionaire clients would ask, the very first, was how much money can you save me on taxes? Not what are the best investments or what's the next hot stock, but how to keep the government out of my pockets. And that's what I'm going to show you today, how to keep as much of your money as possible. We'll start with how taxes on stocks work and how to lower your tax rate by as much as 17% immediately. I'll then show you how dividends are taxed and how to keep every penny instead of splitting it with the tax man. I'll also show you how to calculate your taxes on stocks and what the platforms like Robinhood are telling the IRS. Stick around though, because towards the end of the video, I'm going to reveal the 5 strategies I used with private wealth clients to defer, lower, and even cut out investment taxes altogether. I also want to get your opinion though, of the 5 tax-saving strategies that I'll share later, which do you think is going to save you the most money, or do you have a better strategy to save more? So check those out, scroll down, and let me know in the comments below which is the best tax strategy for stocks. On to the good stuff though, and helping you keep more of your money, because nation, taxes can leave you broke. We had one client in the firm that I worked with, a younger guy in California, that was paying almost 42% of his investment gains to taxes. Almost half of his money. He lost $284,000 in 1 year alone in the year before we started using some of these tax strategies. A lot of that from profits from trading stocks and Bitcoin. Now, stocks are taxed in a couple of different ways, and this is really how the tax man gets you because all this confusion really costs you money. Now, how much you pay in taxes on your stocks depends on 2 things. How long you hold the stock before selling, and your income for that year. You will never owe taxes on a stock until you sell it, so it's going to start with that, and I'm going to use this chart to guide you through how stocks are taxed. And we start here with the question of, did you sell any stocks or collect dividends? We'll look at dividend taxes in the next section, so we'll just move up here to taxes you pay on stocks that you sold over the last year. Now, for each stock you sold, you have to separate this into one of 2 groups. Stocks you owned for less than 365 days, that's the short-term holding period, and those you held for 365 days or longer, the longer-term holding period. And for each of these groups, you're going to add up all your stock gains and losses together. It doesn't really matter how much you made or lost in any one stock, but your total gain or loss in those short-term holdings and the long-term investments. Now, if you did have any losses in either of these 2 groups, so let's say you made $5,000 of profit in the stocks you held for more than a year, but on the stocks you traded, you lost a total of $2,000. You then subtract that short-term loss from your long-term profits and only pay taxes on the remaining long-term profits. Now conversely, if you had profits in both your short-term and your long-term holdings, then you're going to pay different tax rates on each of these. So let's take a step at a time. Here, if you had short-term trading profits, or if you don't have enough losses in those long-term holdings group to offset all your short-term profits, then you're going to add those profit amounts to your income and pay the taxes at your normal income tax rate. Now that's something that a lot of new investors don't realize. All that stock trading or the Bitcoin profits you made last year are taxed at income rates, which can be extremely high. Here are the income tax rates for single and married filers, and you can see these can get insanely high, especially if you made a lot of money in 1 year on that big jump in Bitcoin or Tesla. You might have only made 40 or 50 grand in regular income, but if you made $100,000 windfall in Tesla, that's going to bump you up into that 24% tax bracket and cost you a lot more on those short-term profits. Now, it's also why short-term trading doesn't always make as much money as you think it does. After the tax man takes his share at these higher rates, you're only getting a fraction of that return that you thought you had. Now, on the other hand, for stocks that you held for more than a year before selling, the Those are taxed at different rates called long-term capital gains. Here again though, you're going to add up all the profits in those long-term stocks that you sold, and a loss here can be used to offset some of those short-term gains if you made them. Now another important note here, if you had a loss in stocks that you sold in the last year in both those short-term and the long-term categories combined, you can take up to $3,000 of that total loss, and deduct it from your normal income to save you money on your taxes. Now, if you had more than $3,000 in losses, then the rest you're going to save over for next year's taxes to subtract against those profits there. This is why it is so important to keep track of your investment gains and your losses each year and from year to year. Nation, do not miss out on these tax breaks that you get from your losses or from planning your stock trades. And I know this is a lot of information at first, but stick around because it does actually get pretty easy once you figure out the basics, and it will literally save you thousands of dollars. Now, if you did have profits from stocks that you sold, that you held for more than a year, your tax rate on these long-term capital gains is going to depend on your income level. Here you see the capital gains tax rates, and understand these aren't progressive rates like with your income taxes. Remember, for your income taxes, you pay the tax rate at each level on that much income. So if you made $45,000 income after deductions, then you would pay 10% on that first $9,875. Then you would owe 12% on the amount of income between that $9,876 and $40,125. And then you're going to pay 22% on the rest of your income. Your total taxes owed would actually come out to be about $5,690, or about 12.6% effective tax rate. But that's not the case for these long-term capital gains taxes. Here you pay one rate on all your long-term profits. So if you made that $45,000 in income, then you would owe 15% of your profits in taxes. This is why a good tax planner makes so much money. It takes some strategy, and I'm going to share those 5 of the best tax tips that you can use later in the video, but there are ways to get around this. Folks, please take the time here and do not pay more taxes than you should. It does get better though, I promise. And later I'm going to show you a selling strategy that will help reduce your total tax bill even lower and maybe even pay no taxes on your investments. Now though, I'm going to show you how dividends are taxed along with what Robinhood and some of these other platforms are telling the IRS about you. But first, I want to personally invite you to a free webinar to share the custom investing strategy I developed working with private wealth clients. It's totally free and it's going to show you step by step to creating an investing plan perfect for your goals. So I'll leave a link in the video description below. Check that out. Now, the other side to taxes on stocks is from the dividends that you collect. And this can get really expensive because you have less control over when you collect those dividends compared to when you sell your stocks. You owe taxes on dividends you collect every single year, whether you sell the stock or not. If you collect a dividend, then when tax time comes around next year, you're going to owe taxes on that dividend. And just like with those capital gains taxes, there is a difference here in the taxes that you pay on your dividends depending on how long you own the stock. But here, it's not that 365-day rule, but a 61-day period, and it's a little wonky here how you calculate this, so I'm going to show you here through it with an example. Now, the IRS says any dividend stock you hold for at least 61 days around that ex-dividend date, that's going to qualify for a special long-term tax rate. Now, when you buy or sell the stock really doesn't matter as much, only that you hold it for at least that 61 days, either before, after, or around that period of that ex-dividend date. Now, of course, this usually isn't an issue for most dividend investors because you're not going to be selling your stocks. You're holding and waiting to collect that next dividend and the next and the next. This really is only going to apply for those investors that are selling their dividend stocks. Now, if you do collect a dividend and you sell the stock without holding the shares for at least that 61 days, the dividend is what's called non-qualified, and it's going to be added to your regular income for taxes. Now, it's easy to understand if you think about it in the same terms of those short-term stock holdings. Any short-term holding of a dividend stock, holding the shares for less than that 61 days, then the dividend is added to your income at those higher tax rates. But again, for most investors, if you're holding your dividend stocks for longer than that 61-day period, any dividends you collect are going to be called qualified dividends, and it comes with that lower tax rate. For qualified dividends, the tax rates are the same as those long-term capital gains. So here you're either going to pay 0, 15%, or 20% on your dividends that you collected in the year, depending on your income. So you see, a lot of what determines how much stocks are taxed depends on how long you hold the investment. This is something that a lot of people didn't realize or understand when they were trading in and out of those hot stocks last year or in Bitcoin. This kind of stock trading where you own the stock for less than a year, it's going to mean higher taxes, and that has to factor into your decision. Now, we're almost to those 5 strategies to save thousands of dollars on your taxes on stocks, but I want to clear up some misconceptions about what Robinhood and some of these other investing apps report to the IRS and what happens if you don't report stocks on your taxes. Now, as we've talked about, you pay taxes anytime you sell a stock or collect a dividend. So if you own dividend stocks, you're going to owe taxes on that every single year, whether you sell the stocks or not. If you sell even 1 share of a stock, then there's going to be taxes owed on that if you made a profit from how much you paid and what you sold it for. And now, just like for your income taxes, you pay investment taxes in the following year. So any dividends you collected or stocks you sold in 2020, you file those on your taxes in 2021. One of the most frequent questions I get from investors is, what does Robinhood or other stock platforms report to the IRS? What information is my broker sharing with the IRS for taxes? Any stock trading platform on which you collect dividends or sell shares is going to send the IRS what's called a 1099 form each year. They're going to send you a copy of that as well. You'll get a 1099 DIV that shows the dividends received, both qualified and non-qualified. Then you're going to get a 1099B that's going to show your gains and losses on stocks you sold. The 1099 DIV showing your dividends collected is pretty straightforward. You can see here I only collected qualified dividends last year, but if I had any of those non-qualified dividends, they'd be shown on another line. I just take the amount for each of these types of dividends and then put it on my tax forms. Now here, the 1099B you receive is first going to summarize all your short-term and long-term capital gains, breaking each out for you and adding everything up. Even though most platforms make it easy like this, you still want to double check with each stock that you sold just to make sure that your totals add up right. Most brokers are also going to list out individually each stock you sold as well. So you see, it's not like you can just not report something to the IRS for your taxes because they've already got a copy of what Robinhood or any other platform is saying. Not reporting stocks on your taxes can trigger an audit, and that's where the IRS is going to look at your entire tax form and could give the taxman other things to look at besides just what you reported in stocks. So unless you want to spend the week frantically going through boxes of receipts to present at your tax audit, report all your stocks and your dividends on your taxes. I know it's a lot to cover, and you might have to review some of this before you really understand the basics of how those stocks are taxed. But now I want to share those 5 strategies that will save you thousands of dollars on your taxes. Understand here, though, that we're not talking about cheating on your taxes. Everything I'm about to show you is totally legal, and it's how the rich lower their tax bill to almost nothing, while the people that can't afford those high-priced tax accountants, while they pay this country's tax bill. Some of these strategies are going to help you lower your tax bill. Some will make it so you don't have to pay those taxes for years, and some are going to help you cut those taxes completely. First here, put all your high-yielding dividend stocks into a retirement account. Now you're going to owe taxes on those dividends you collect every single year, whether you sell the stock or not. That is, unless you receive the payments in a retirement account, like an IRA or a 401k. Dividends received in a retirement account aren't taxed until you take that money out in retirement, so you keep the entire dividend and get to keep earning returns on it for decades to come. So what you do here is list out all your dividend stocks that you own or the ones you want to buy in the order of highest yield, and then max out your retirement contributions on those with those higher payouts. Because of the contribution limits, you might not be able to get all your dividend stocks into a retirement account, but make sure you get those biggest payers first. Next here is a great one if you itemize deductions using a remainder charitable trust. This is one of the biggest tax strategies we use with private wealth clients. And here's how it works. Instead of selling a stock, you donate it to what's called a remainder charitable trust. The trust holds that money and pays you an interest rate, usually between 5 to 8% of the amount that you donated for as long as you live, then just keeps whatever is left. And why this is such a great tax strategy is because you get an instant deduction on your taxes for that full amount that you donated. Say you would have sold $10,000 in stock with a long-term capital gains of $5,000 and you're in that 20% capital gains bracket. That means you would have owed $1,000 of the taxes on those stock profits. Instead, though, by donating it, you get to take that full $10,000 off your income, which is actually going to save you about $3,500 in income taxes, depending on your rate. So you're already getting nearly $5,000 in savings here. But, and here's the kicker, you also get that $500 or more with the payment every year from the trust. So you've got a guaranteed income stream for life, plus the tax benefits. Our next tax strategy here, choosing which stocks are sold through your broker, and I'll show you how to do this on Robinhood. Now, the problem here is when you sell shares on Robinhood or most other broker platforms, it uses a first in, first out rule for selling those shares. For example, if you own 500 shares of Apple that you bought over different time periods, say 100 shares a month, if you sell 200 shares of that, then Robinhood is going to sell those first 200 shares that you bought. Now, most of the time, if the stock price has increased, that's going to mean those higher taxes owed. Those first shares that you bought were probably the lower price, so you're going to owe more in that capital gains tax when you sell those. There is a way to change this rule though. You can tell the platform to sell the newest shares that you bought, the highest price ones, and that's going to mean that the capital gains you report won't be as high, or maybe even can give you a deduction. Now on some platforms, it's going to give you the choice of deciding which shares you want to sell when you place that sell order. Robinhood doesn't make it so easy, but they do allow you to change that, and here's how you do this. When you sell some of your shares in a stock and you want to change it to those newer shares that you bought at the higher price, contact customer support through the Robinhood Help Center page. Now here, tell them the sell order that you placed and the specific group of shares you want to sell. Now an important note here is that this has to be done within 2 days of making that trade. That's the settlement date. It's best to just do it right after you sell the shares. I know it might seem like a lot of work, but this can significantly reduce your taxes in any given year, especially if you're selling those higher price shares that you bought instead of the older, cheaper ones. Now, of course, understand that you're still going to have those lower cost shares in your account, and you're going to have to pay taxes on those eventually, but not until you sell. So it's great to be able to defer that higher tax bill until years into the future. Now, this next one might not sound like a tax saving strategy, but can be huge. Just thinking twice about that short-term trading. Nation, I know those quick trading profits can be tempting, but once you pay the taxes on these, a lot of times you really haven't made that much money. For example, for someone in that 32% income tax bracket, you're paying double the taxes on short-term trading as you would those long-term capital gains. Say you made a quick 10% or $1,000 on a $10,000 investment, but after you pay that 32% income tax on it, you really only made about 6.8% return. So you've just got to ask yourself, especially at those higher income tax brackets, is it really worth stock trading if Uncle Sam is going to be taking such a big chunk of your profits? Instead, just keep your stocks for at least that 1-year time period and save that extra money with the lower long-term capital gains rates. Also here, track your gains and losses throughout the year and use tax loss harvesting. Now this idea goes beyond just taking losses against your gains to lower the taxes that you owe. With tax loss harvesting, you can go further and completely eliminate taxes for that year. Now, how this works is you track those gains and losses so that you know how much total gains you have through the year. Then, before the end of the year, you sell enough of your losing investments to offset any gains. Now, I usually do this planning early December, maybe late November, finding which stocks I can sell to produce enough of a loss to cover my gains. Now, the best part is, though, since you can designate which specific shares you want to sell, you can sell a part of your investment in a stock, maybe the newest shares that you bought at that higher price that's going to give you the biggest loss, and you can still hold on to some of the rest of those shares in that company. It doesn't have to mean you sell completely out of your investment in any one company. Click on the video to the right for the 7 dividend stocks I use to pay my rent. 7 dividend payers that put money in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.